Hi, everybody. This is my screencast for Chapter 13 on corporate formations and operations. And what we're going to learn about in Chapter 13 is computing the tax consequences of transactions in which the shareholder transfers property or services to the corporation in exchange for stock of the corporation. We're going to look at the tax consequences of that, and then after that we're going to talk a little bit about income tax formulas and contrasting the corporate tax formulas with individual tax, and we're going to look at common book tax differences between them and distinguishing between permanent and temporary differences, which should be, I think, a little bit old hat for a lot of you with the accounting background, maybe not, and then we're going to talk a little bit about reporting, and that'll be it for my screencast for this one. So with that said, let's get started. Okay, tax-deferred transfers of property to a corporation. Without some kind of non-recognition provision, a taxpayer who transfers property to a newly formed corporation and gets stock back would have to recognize gain or loss, because what it really would be construed by for the service would say that was a sale, and when you have a sale, when you have a complete transaction like that, it's a taxable event. And so the difference between the fair market value of the stock received and the taxpayer's adjusted basis in the property that was transferred in, that's gain to the taxpayer probably, and the taxpayer then would have to pay taxes on that. Well, that's all a scenario if there wasn't some kind of non-recognition provision within the code to be able to make this happen without anybody paying tax. So actually, to our luck, there is. Transfers of property to a corporation are known as a 351 transaction. And a 351 transaction, it comes from the code section 351, overrides the usual tax consequences that I just talked about. So what's the purpose? What's the rationale behind this? 351 facilitates formation of corporations by deferring. You don't get away with not ever paying tax if you're a stockholder on the transfer, but what it does is gain and loss is deferred on property transfers that meet the requirements, so that at the initial stage of corporate formation, there is no tax consequence. 351 applies to transfers of property in a C corporation if property is transferred into a C. It applies to an S corporation, and what it primarily looks at is even the application to corporate subsidiaries. So if a subsidiary has a 351 transaction, there's no tax liability for that. And because it applies to subsidiaries, by definition then it applies to transfers to pre-existing corporations by their controlling shareholders. So that's where we're heading to talk about 351 and specifically how it operates. At the corporate level, IRC section, Internal Revenue Code section 1032 provides that a corporation doesn't recognize gain or loss when it receives money or property in exchange for its stock. So at the corporate level, a corporation, a new corporation, an existing corporation, if it gets some kind of money, property, there's no gain recognized on the corporate side of things when it receives that material, okay? The rationale for 1032 and 351 is this. Congress looked at this and said, what's actually going on here? What's really happening? And what they came to the conclusion was, you really don't have a taxable transaction happening. What you have are changes in form. So the shareholder is changing the form of what they hold from, say, property or money to stock, and the corporation itself is changing what it holds from stock to money or property. So there's really nothing going on other than, in terms of value, that's taxable, other than an exchange of items back and forth between stockholders and corporations. And so because of that, because it's a mere change in form, where it's not a taxable event. Surprising coming out of Congress. Okay. Tax-deferred transfers of property to a corporation. Section 351, tax deferral requirements. To transfer property to the corporation, and I will tell you right up front, not services. It's not doing services in exchange for stock of the corporation. That's a 351 transaction. So I transfer property, money or goods to the corporation, I get stock back. Now, as a stockholder or potential stockholder, if I get, in addition to the stock, I get something else back, and in tax lingo we call it boot. If I get boot back, which means something extra besides stock, I'm going to probably realize gain on that exchange. Not probably, I will recognize gain on that exchange. I don't get to recognize any loss. And afterwards, after this happens, so let's say I'm a stockholder. I transfer property, let's say appreciated property, or I transfer money to the corporation, and in return, I get stock and money back to me. That means I got not only the stock, but I got boot back, and so I'm going to probably recognize gain on that. The tax laws say I can't recognize any kind of a loss. And in addition, to make the 351 transaction work, after this exchange happens, we're swapping things back and forth, I, as the transferor of property, have to be in control in the aggregate of the corporation. So in the aggregate, the couple things I want to point out. When I talk about in the aggregate, what I'm talking about is that if there's more than one of us, several people want to get a corporation up and running. And so they transfer assets to that corporation. The corporation in return gives them stock. To make a 351 tax-free, what needs to happen is at the end of that swapping, we, the stockholders, have to be in control of that corporation. So that means, what's control look like? Control looks like we got to own 80% or more of the corporation's voting stock and 80% or more of each class of non-voting stock, if there is such an animal out there, from the corporation. That's control. We have to be running that corporation for the 351 to be effective. 351 is also linked to other Internal Revenue Code sections. So to preserve any gain or loss in the shareholder's stock basis, 358 is involved, Section 358, and Section 362 is the corporation's basis in the transferred stock. And I'll get into all of the basis rules in a few minutes. These basis rules include limits to prevent the duplication of losses, but not duplication of gains. So let me explain what I just said. When Congress was doing this, they didn't work totally out of the goodness of their heart. So the rules include rules for you can't duplicate losses, which is why on the transfer of boot, for example, the taxpayer can't recognize a loss because Congress looked at it and said that loss was already locked in the corporation. So we were only going to let the loss happen one time, not twice. On the other side of the coin, though, Congress had no problem with saying, well, you know what? The corporation's making money, so let's tax that same income twice. And that would be a good thing for us. And so Congress is basically saying, we're only going to give you one loss. It's only going to be recognized in the corporation, but we're going to tax your income twice. That's what I have noted here is Congress wanting its cake and wants to eat it at the same time. So that's non-recognition and basis. Some definitions for you guys as to what I'm talking about. For example, what is property? Because that's part of the definition, the transfer of property to the corporation. And stock for purposes of Section 351. So definitions for you. Property. Property that can be transferred into a corporation can include cash. It can include inventory. It can include accounts receivable. It can include intangibles like goodwill, industrial know-how, patents, Things like that are considered under the code to be property and under the regs to be property. Transfer, what does that mean? To transfer that property means that you can't hold, as a stockholder who's transferring that material into the corporation, you can't hold any residual rights to it. You can't hold things back, in other words. Transfer means all substantial control of that property goes to the corporation. Now, where do you see that in the real world sometimes? Particularly in knowledge type assets like patents, you will find stockholders who are at least reluctant to turn over what they have totally to a corporation and to let go of whatever link they have to it. But for a 351 to work and for it not to be considered a sale or exchange, total transfer of, say, that knowledge asset, that patent, has to be turned over to the corporation. The stockholder can't retain any residual hold on it. And stock, what do we mean by stock? Stock means equity ownership, that what the taxpayer gets back is total real stock, not stock rights, not convertible debt, not stock warrants, something that down the road could be construed as stock. No. What 351 to work says, at the end of the transfer process, what's got to happen is that stockholder has to be a real owner and in control of that company. And the only way that that can happen is through having 80% of the real stock in their hands at the time the transfer is over with. So that's some definitions I wanted you to understand as to how it's construed by the IRS. Because remember, the service, when it looks at a 351, will always be looking at flaws in the transfer process itself. So it's critical for the CPA or the tax lawyer or both who are helping the stockholders create this corporation or move stock into this or move assets into this corporation to do it in the right way so that they get tax-free treatment. Okay. Let's look at the tax consequences when a shareholder receives other property, the boot in tax jargon that I talked about a little bit earlier. Okay, a shareholder recognizes gain, but not loss, as for the explanation that I just gave you guys a couple of minutes earlier, in amount not to exceed the lesser of gain realized or the fair market value of the boot received. So what does that mean? The service will look at whatever the asset is that the stockholder got in addition to stock on an asset by asset basis and make the consideration or the conclusion about gain on that asset by looking at each asset. So it's either the gain realized or the fair market value of what's ever received. So let me give you guys an example. Let's say that I just did a 351 transaction with a new corporation I want to be involved with. That corporation, what I gave it was some appreciated property, some appreciated land that I have, and the idea being that the corporation will build its facility on my land. In return, what I got is stock equal to probably the fair market value of the land, and in addition, say the corporation gave me $1,000. So I got stock in the value of the land plus equal to the fair market value of the land, and I got $1,000 back. Well, that $1,000 is boot. And so the service would look at it and say, okay, looking at that amount, what's the lesser of gain realized or fair market value of property? Well, there was no fair market value of property, so the gain realized is $1,000. So I would have to show gain, I would have to show income of $1,000 in addition to the stock. Now, if, for example, in return, let's say I gave the corporation that same land, and in return, they gave me back another piece of land, and in addition, they gave me the $1,000. So I got $1,000 back, and I got the land as well. So then what happens? That's all considered boot. So I would look at the fair market value of the land, I would look at the $1,000, I would add that all up, and I would have to allocate what I got back to the property that I exchanged for on a pro rata basis. So what it means is what? I'm probably looking at the lesser of gain realized or fair market value of boot received. If I got the land with no additional liabilities to it, then that the fair market value and the dollars would be added together, and that's my gain for the property that I got back. Okay, tax deferred transactions. The character of the gain that I get when I'm trying to construe this gain depends on what was transferred to me. Okay, so what does that mean? It could be capital gain. Maybe I got stock back in another corporation, and that's a capital gain. Maybe I got 1231 gain, and what 1231 gain is that's depreciable assets, normal business assets. Maybe that's what I've got that I have to consider. Or maybe it's just ordinary income, including depreciation recapture. So those are just what it basically is saying, and what my slide is saying to you is this. When I look at the gain, it carries when the corporation gives me the transfer back, or when I transfer to the corporation, it maintains. Remember, it's just a swap again. It's just a change of one thing for another, supposedly of equal value. And so it carries the type of gain that it would be in either case. It's just not taxable at that time. And as I note here, boot is tax basis equal to its fair market value, as I described in my example on the land. But generally, the character of a gain, any that's recognized, is going to carry with it the character that it had when it started out. It doesn't change character. 351, let's talk a little bit about control a little bit more. Collectively, 80%, as I mentioned before, of all classes of stock. While somebody one of the stockholders could receive non-voting stock, and others get voting stock, as a group, they have to own 80% of all of the stock involved after the exchange. And where it gets really complicated, and it's more complicated than what this course demands, is what happens if a transfer disposes of stock right away after the exchange, because that happens. Sometimes somebody will get stock in a 351 transaction and immediately afterwards sell it, or get rid of it in some way, or trade it to another corporation. And all of a sudden the complexity of the 351 got much higher and much more confused. So what I want you guys to take away from this at this point, don't think about the immediate release of stock after the exchange and what the tax consequences of that are. What I want you to just think about is that whatever types of stock come out of the corporation in exchange for assets has to give those who get the stock control of all classes of stock immediately after the exchange. Okay, special problems in relation to a 351 exchange. And this happens a lot too. Stock issued for services is not considered property for purposes of 351. So to be able to have 351 operate, there has to be an exchange of property. And giving the corporation services is not considered property under 351. A service provider, somebody who gives the corporation services, has, if they get stock back, ordinary income under Section 61, which you guys are familiar with now, on the value of any stock that they get back. So if I'm just providing services, I'm not doing anything else, when I get stock back, I'm going to have to pay taxes on that. And the timing of income is controlled by Section 83. So what am I talking about? Section 83 says if the stock I get back as a service provider has a risk of some forfeiture, or it's not transferable, I can't do anything with it, I'm taxed on the fair market value of the stock at the time the restrictions lapse, not right away. So in other words, let me explain. I get stock back, and there's a timing issue involved with the stock that I get back from the corporation for the services I provide. That timing issue says, well, you don't get the stock right away. It doesn't vest right away until all the services you're providing for us. Maybe I'm a computer programmer, or maybe I'm an app writer or something like that, And as part of my pay, I'm getting stock in the corporation. That's a pretty typical thing. I'll help you develop some kind of new application for your company, Microsoft, but I'm an independent contractor, and instead of money, what I would like to get is stock in your company. And Microsoft says, sure, we'll do that for you, but until the app is developed and up and running, we're going to put restrictions on the stock, and it's not yours until that's all completed. Well, so me, as the developer, recognizing that income, I wouldn't have to recognize the income until that restriction disappeared. Until I delivered the app. When I deliver the app and the restriction goes away and the Microsoft stock is now mine, that's when I recognize the income. Okay? Now, one quirk in this is that the provider can elect to be taxed immediately on the fair market value of the stock, and then nothing more is owed. What would be the rationale for that? Why would I do that? Well, again, using my example of Microsoft, if I'm developing an app for Microsoft as an independent contractor, and as my pay, I get restricted stock, restricted by the fact that I have to complete the service before the stock comes due, I can elect to say, you know what I'll do? I'll pay the fair market value on that stock right now that I know I'm going to get. I'll accept the gain right now and pay taxes on it, and then I won't owe any more. Well, the rationale obviously is this. That stock could go up in the meantime between the time I start development and the time the restriction finally lapses. And if it goes up in value, I have to pay greater amounts of tax because I've got a greater gain than I had before. So I'll take what I say the value of the stock is now, or what the value of the stock is right now as I start my work, and I'll pay my taxes right now. And so I won't owe anything down the road. And that's the issue with that. Okay. If the corporation, on the corporate side, issues stock for services, the corporation has a normal business deduction. It's 162A business expense, and it's ordinary income, okay? And it's taxable to the service provider, what I just said. This is just a summary of that. If a service provider receives more than 20% of any class of stock as payment for services, the whole 351 transaction falls apart. So think about what I just said. If for some reason, and I don't know, there's just bad tax advice, for example, if a corporation pays out to a service provider more than 20% of any class of stock, that prevents anybody else from having an 80% control of that class of stock. And as you guys now know, under 351, for it to work, the stockholders at the end of the transaction of the trade have to have 80% control of all classes of stock. So if it's paid by the corporation to a service provider who is not considered for 351 a stockholder as such, or a person in control, the whole thing falls apart. The whole 351 transaction falls apart, and all the exchanges that occurred become taxable. So again, you need a good tax attorney, or you need a good CPA to know what they're doing to be able to advise management if they are clueless about how this works. Okay, now typically I won't go through examples for you in my screencast because you've got the examples right there in the book, and I encourage you guys to work those examples that have answers in every chapter because it will help you understand the concepts. The book does a good job of explaining the concepts and then giving you an example afterwards. But this one I wanted to talk about, and I threw it up here just for you to see what I mean by how this thing can fall apart. So if you look at my example here, what we have is two people in a corporation. We have Sarah, Nicole, and Chan's Inc. Okay. Sarah gets 25% of the stock, the new corporate stock the corporation is being evolved, and she gets 25% in exchange for services. Nicole gets 50% of the stock in the new corporation in exchange for land, appreciated land. And lastly, the corporation, corporate stockholder, gets 25% of the new corporation in exchange for cash. Okay, does Nicole recognize the gains she realized on her transfer of appreciated land? Think about it. What's your answer? I'll give you 10 seconds. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. What's your answer? Your answer should be yes, she does. And why? What I just said to you. If a service provider gets more than 20% of any class of stock, what happens? The 351 transaction, the exchange transaction, falls apart. And so that's the answer here that you have. Because Nicole and Chan's Inc., when they're done with the transfer of property, only their stock counts, first of all, for the control test. And because it was a service provider, considered a service provider otherwise. So what happens? At the end of the transaction, they own 75% of the stock, which isn't enough for the purposes of 351. So all of a sudden, every transaction that happened, all the exchanges become taxable. Okay. What happens when a corporation assumes liabilities? So, for example, let's take again, I have a piece of property that I want to transfer to a new corporation. That piece of property is mortgaged, and it has a fairly substantial mortgage on the piece of property. I give it all to the corporation. So not only do you get the land, but you also get my liabilities or the mortgage attached to that land. The general rule is even though I, as the transferor, is relieved of debt by transferring liabilities to the corporation, this assumption of debt's not treated as boot by the transferor. So that's a good piece of news, right? I get rid of the liability. And it's not the fact that the corporation accepted the liability. I don't get stuck with any taxable gain, say, from being relieved of the liability. I don't have any additional boot. Now, that's great on its face. Sounds good. Okay, so I've got several pieces of property. I want to put them in the corporation. They're all mortgaged to the hilt. I want to put them in the corporation, and I don't have any boot on this exchange. And I get stock back. So now I'm a controller, and I have control of the corporation. The corporation holds all these assets with the liabilities attached. Okay, pretty good deal. Until you have to consider the exceptions that are involved. If the service looks at that transaction and says, wait a minute, you're doing this, it sounds too good to be true, right? You're doing this to avoid paying taxes on this exchange. All of a sudden, you as the transferor or the stockholder, you're getting rid of all these liabilities, and you don't want it to be boot. So you're doing this and saying, wow, I got rid of those liabilities. I don't have any boot. This is a great deal. And you're only doing that for tax avoidance purposes. There's no solid business reason behind it. And let me give you an example of how that can happen. I'm going to be a stockholder in this new corporation. I'm going to be the transferor in this new corporation. I know that I'm going to be giving land. And so I want to get some money on the front end because I know that if I borrow against this land before this transaction takes place, I can just give the liabilities to the corporation and I'm out from under. So I go to the bank before the 351 happens and I say, I want to borrow to the hilt on this property. I don't really need to, but I'm going to borrow to the hilt because I can keep some of that money then. Anything in excess of the liability that I owe, if I'm borrowing, I'm putting it in my pocket. And then I'm going to give all that liability, including that new debt, to the corporation, and I'm free and clear, and I got money in my pocket. Well, the IRS would look at that and say that you're only doing this for tax avoidance purposes. You're trying to get rid of the liabilities. You're trying not to pay anything as far as that would be considered boot and tax on that income. So that doesn't happen. What we're going to do is we're going to say those liabilities that you got relieved of is boot. And in other words, that becomes, all those liabilities become income to the transferor if we see this as being done for tax avoidance. Okay, so that's one exception. Second exception is liabilities assumed by the corporation have no business purpose at all. So, again, an example for you, I just went through a divorce. I have an obligation to pay a ton of money in alimony. I'm a rich guy, and to my spouse, I've got a barrel of money that I owe in terms of alimony. That's a liability. It's written down in a legal document as part of the divorce that I have to pay this alimony. Well, I think I'll give that to the corporation as well in return for stock. And now the corporation has the obligation to pay alimony for me. Again, that won't fly. Liability of what the service would consider to be personal, non-business assets, again, or the corporation assuming the liabilities won't fly, and the 351 would fall apart if I were the only stockholder based on that. So again, you have an issue. You have to be aware this works pretty good as far as a corporation assuming liabilities, assuming what you're doing is ethical and above board. You're not trying to avoid taxes. You're not trying to get rid of personal obligations. Okay, what happens when the liabilities exceed basis of properties that I transfer to a corporation? Even when that happens, it's still not considered boot. The shareholder will recognize gain to the extent liabilities assumed by the corporation exceed aggregate basis of property contributed. Okay, so what am I saying? It's not considered boot unless the liabilities assumed by the corporation exceed my basis entirely. This doesn't apply if the corporation itself would have a deduction. So assuming accounts payable, for example, of a stockholder. If the corporation assumes my accounts payable and pays those debts, the corporation would have a deduction for that, and so the first bullet doesn't apply. So what would happen then, because the corporation gets a deduction for it, I don't have to pick up taxes on it. And that's liabilities in excess of basis. Okay, what else? Property, let's talk about that, and let's talk about calculating basis and holding periods and those things. Let's get into some tax lingo here. Property transferred to a corporation solely in exchange for stock. This transferor's basis in the stock received is equal to the basis in the transferred property. Okay? So keep in mind that it's just an exchange of one asset for another in Congress's mind, and not much else is changing. So I get stock, and the property goes to the corporation, and the basis basically substitutes in tax lingo for what I get back. So if I, for example, get I get the stock back, I have a substituted basis that was my old basis. Corporation has my basis in the property. So if I get more than one class of stock, the aggregate basis then is allocated amongst the different classes of stock in proportion to the fair market value of each. So in my holding period, again, tax lingo is tacked to the holding period of the transferred property. So let's say this is a capital asset for me. I had property that I've held for 5 years. And so what happens, and my basis in that property, let's say it's a $50,000 piece of land now, fair market value, and I bought it for $10,000. So I've got $40,000 of gain tied up in that property. What that means is when I send it to the corporation, they now have an asset with a fair market value of 50 and a basis of 10, and I have stock with what I would have is the basis of my transfer property of 10. What's tricky about that, and this is again Congress being really great, and I'm being facetious, gain is tacked in two different places in general on something like that. So I've got property when the corporation gets rid of the property, they pick up gain. When if I sell the stock sometime down the road, I pick up gain based on that basis. Now, what happens too is since I held the property for 5 years, the holding period for the corporation is the same. It's tacked to the holding period of the transferred property. Okay? And what another tax lingo here is just carryover basis, my last bullet. The corporation's basis in the asset received from the shareholder is carryover, which means the same as the shareholder's basis, what I just said. Okay? Contributions of capital. Transfers of property but no stock or other property is received in return. What does that mean? It means that I give appreciated property to the corporation. I don't get anything back. The corporation, as we just talked about, gets a carryover basis in the property contributed. And if the property is contributed by a non-shareholder, the corporate basis is 0. And what happens for me then in that case? My basis that I already have. So what I'm saying is, let's say that I've already, the 351 has already happened. So think about down the road a little bit. The 351 has already happened, but I want to continue, I want to build up the value in the corporation, so I give it a piece of land and I don't get any stock back. Even though I don't get stock back, what happens, the stock I already have from the initial 351 increases in value by the basis of whatever the property is that's contributed. So let's say initially the example I gave you guys, I contributed land in a 351, and we talked about substituted basis and carryover basis, and the tax lingo and tacking of holding period. Well, now we're down the road a little bit. I want to increase the value of the corporation, so I give it another piece of land. That piece of land is worth fair market value $100,000. My basis in it is $50,000. Okay, the corporation gets my basis in, takes a carryover basis in that property, but I don't get any stock back. So what do I get? If I've already have stock through the 351, all I do is my basis of the property that it's contributed goes up. So, or my stock goes up by the basis of what I contributed. So if the land was worth $50,000 initially, or that's what I purchased it for, my stock value increases by $50,000. So my stock basis increases. Okay? Is that clear to everybody? Tax tip. This is my tax tip for you guys, for your future clients that you might have. My tax tip is this. Don't let your clients transfer appreciated property to a closely held corporation like a PC. The example I just gave you about is just to make a point. I would never do that in real life. Why would I not do that? Or at least I would not encourage my clients to do that. Transfer appreciated property to a closely held corporation. Because of the example I mentioned to you a little bit earlier. What happens when that happens? You've got, remember, Congress is really tricky about not letting you take losses, but they're more than happy to tax you on gains. And the example I gave you a few minutes earlier was, okay, I transfer appreciated property that I have. I get stock back with the same basis. Remember, we substituted basis for each other. And so I've got stock with the basis of the property I transferred in. The corporation has the property with the same basis that I had. So then what happens on the appreciated property? The corporation, if it would sell it, pays on the difference between the fair market value of the property that's it's holding and its tax basis, which was mine. It pays that's income to the corporation, assuming they make money on it. So they pay tax on that. On my end, I have a basis in my stock that's the same as what it was in the land. So now the stock appreciates. I sell the stock. I pay tax on that gain. So the same basic asset is getting taxed twice with the same gain. Well, that's just stupid to let that happen. So, because there's always an answer to these things. So don't let your clients transfer appreciated property, like the example I just gave you, in real life into a corporation, because that double taxation of gain will kick in. So my advice would be always lease the property to the corporation. Then the corporation gets a leasing expense. You've got income, but you've only got your gain taxed once. Okay, and so that's just a tax tip for you. Now, the only reason that I would change that, every place, every municipality has different ways of handling property tax. And so unless the state that you're in has some amazing benefits that are attached to property taxes as far as deductions, maybe then you would give appreciated property to the corporation. But as a general rule, I'd never do it. So that's my tax tip for you. Okay, so that's 351. I hope everybody's got it. The idea of transferring property, the idea of you have to be in control afterwards, the idea of substituted and carryover basis, the idea of tacking of holding periods. That's all a 351. The idea that you can't do these things for tax avoidance purposes or to get rid of personal issues. Otherwise, you're going to pay tax on the gain. That's all 351. So now what we're moving into is book tax adjustments. And you guys are pretty familiar with this, I'm assuming, with your accounting background, so I'll kind of skim this pretty quick. But financial income, typically, your financials, your GAAP created financials, is typically the starting point for computing taxable income. And then you make reconciliations, as you know, to those to that GAAP created financials for tax purposes. And again, tax accounting methods, if a company prepares using tax accounting methods, prepares their financials, then they won't have book tax differences. But that doesn't happen all that often. Most of the time, because of GAAP and because of the conservative idea or philosophy behind the creation of GAAP type documents for your financials, you're going to have book tax changes or adjustments that you have to make. Okay, the adjustments are unfavorable and favorable. Unfavorable means that you have to add back to book income to compute your taxable income. Remember that, again, the conservative nature of GAAP says we're not going to pick up income until we have complete control of the income, where we will try and accelerate expenses if we can. Well, when you have an unfavorable adjustment, that means you're adding income back into your books that's going to become taxable income. So you're increasing income. And you're increasing your taxes, in other words, an unfavorable adjustment. Favorable means that you're taking income away to reduce taxable income. Permanent differences in these adjustments like this, again, you're changing book to tax. Permanent differences arise in one year and never reverse. Temporary differences arise in a year and reverse in a later year, and I'll get into examples of those in a second. Here's some common permanent book tax differences. Interest income from municipal bonds, for example. Death benefit from life insurance on key employees. Well, so what does that mean? Why is that a favorable? Just as an example, using the death benefit from life insurance. Okay, so that income is you would pick it up as income for book purposes, but for tax purposes, it's not taxable. So it reduces your tax liability. So that's a favorable book tax difference. Life insurance premiums to get that key person insurance. Those premiums are deductible for your book purposes. They are not deductible for tax purposes. So that increases your income, and you're going to have to pay more tax because of that one adjustment. How about meals and entertainment? For book purposes, most corporations will deduct the entire amount of meals and entertainment that they spent in generating new clients or new customers, whatever, for book purposes. As you guys already know from my last screencast, you can only take 50% of meals for tax purposes. So again, your income is boosted for tax reasons, so it's an unfavorable adjustment. And you can go down this list. Federal income taxes, for example, there's another one. Federal income taxes are deducted for book purposes, obviously not deducted for tax purposes. So again, it's an unfavorable adjustment. Okay, so this domestic production activities deduction, that 9% is a tax adjustment, not a book adjustment. So again, those are examples of permanent book tax differences, things that won't reverse, things that won't change further down the road. Temporary differences, dividends. A dividend is a deduction for book purposes. It's not for tax purposes, but that will turn around later. Depreciation will turn around later. And all of these expenses that I have here, all of these differences will eventually reverse themselves one way or another. Favorable becomes unfavorable, unfavorable becomes favorable. with temporary book tax differences. And so there's a whole list of them that you guys probably know. Okay, let's talk about stock options real quick. Incentive stock options are not deductible for tax, and they get an unfavorable book tax difference because incentive stock options are deducted for your GAAP financials, but they aren't for book. Non-qualified stock options, they're deducted for book purposes as they vest, as they become qualified, and the bargain element then becomes taxable when the bargain element is exercised. For tax purposes, it becomes income. So what's a non-qualified stock option? Stock options, you guys understand how stock options work, I assume, but generally what happens, I'm a good employee. I'm a good employee and I'm working for a big company. And the company says, you're a good employee, so what we're going to do is we're going to give you stock options that you can exercise at the current exercise price. Let's say the stock's $1 a share. That's your stock option, and you can exercise that when it vests, say 5 years from now. We're going to keep giving you options to purchase stock at $1 a share for the next 5 years because we want to keep you on board. We want you to stay with this company for 5 years. At the end of 5 years, those stock options vest, and you can exercise them and buy the stock for $1 a share. Okay, for book purposes, we're probably going to deduct those options each year. We're going to show that as a business expense. But for tax purposes, nothing really happens until the option's exercised. At the end of year 5, let's say that stock is now $5 a share and I pay $1 for it to exercise the option. That bargain element of $4 becomes taxable income to me, just like salary. And so I'll wind up paying taxes on it. Okay, net capital losses. Corporation has no current deduction for net capital losses. Capital losses in excess of capital gains would typically generate capital loss. Corporations can't deduct that. All they can do is carry it back 3 years and carry it forward 5 years to offset capital gains. So what happens then is this. No, you can't take a current deduction for it, but you've got to carry back and a carry forward to help you reduce whatever your capital gains were in those years. And typically what happens is you use a FIFO method to apply those. And again, this is an unfavorable book tax difference in the year of the loss. Why? Because the loss is deducted for your GAAP financials. It's not deducted on taxes. Okay? And then what happens, this is one of those temporary book tax differences that reverse. So if you've got a net capital loss, an NCL, somewhere in this year that you can't deduct, but you carry it back, you can reduce your capital income by that amount. And capital income for corporation is just ordinary income, but you can reduce it, and in other words, reduce your tax liability in the carryback and if it goes forward. After 9 years, which would be what? You're going back 3 years, you're going forward 5, that's 8, and your current year is 9. If your net capital loss is not all used up in that 9-year period, then it expires. It's no longer any good. And again, as I just mentioned to you, net capital gains are taxed at ordinary income rates. So if you can deduct capital losses against those capital gains in prior years or in future years, you're reducing your tax liability. So it does have a benefit later on, but not at the current time. NOLs, net operating loss deduction. Again, excessive deductions over gross income. So what happens is you have an operating loss. You got more business expense deductions than you have income. Okay, there's no current benefit for an NOL, just like net capital losses in the current year. But again, you have carry back and carry forward provisions in the code so that if a company has an NOL in a year, they can carry it back 2 years and they can carry it forward 20 years to offset taxable income in those years. So you don't get a current benefit, but you got a carry back and a carry forward again for an NOL. And some companies may decide not to carry it back. Why? Why would they do this? Well, think about it this way. If you had income in the past 2 years, but it was taxed at a fairly low rate, maybe you're a startup corporation and you really didn't have a lot of income, so you weren't in the top echelons of the tax or of what your taxes would be. Let's say you're paying 15% instead of the maximum rate of 35%. Well, and now your company's growing and taking off and really doing well. Maybe it makes more sense to forego the carryback and use the carry forward so that you're taxed. It drives down your marginal rate in the future when you start making a lot of money. Okay? But the downside to that thinking is if you have an NOL and you carry it back, you can apply for a refund. If it allows you to get more money back, you can apply for a refund instantly. And if you don't do that, if you forego the idea of a carryback and just stick with a carry forward, then that refund, you're giving up the money that you would have. Okay. Okay, here's just information on the deduction. My second bullet there explains what I was talking about. If you have a carryback, apply for the refund immediately if that's what you're going to do, because you're going to get money back. If you're going to forego the carryback and go strictly with the carry forward, this is what you give up. You give up the dollars involved. Okay, charitable contributions. Corporations get charitable contributions just like people do. So what's the amount? How much can they take? Generally, if I contribute property to a charity, I get a deduction of fair market value of whatever that property is. If I contribute ordinary income, whatever the value of that ordinary income property is. Okay? And how do we handle it for book tax purposes? It's deductible when accrued if approved by the board of directors before the year end and paid within 3.5 months. So let's say I've got a piece of property that I want to give to the Catholic Church, or I want to give to Regis, for example. The fair market value of that property is $10,000. It's accrued on the books as a charitable contribution as an expense. It's deductible. It's also deducted on my income tax return as a charitable contribution if those things happen. So the board of director approves this contribution before my tax year's out, and I actually give the property away within 3.5 months after the end of my tax year, then it's a charitable contribution deduction for my corporation. Okay, what's the limitation though? 10% of taxable income before deducting any of these items. So when I'm figuring my taxable income, I'm limited in my charitable contribution to 10% of whatever that is. For most corporations, this isn't, a going corporation that's making a lot of money. This still allows plenty of dollars to be given to good charitable organizations. If you think some of our largest corporations that are out there and what they make on an annual basis, even with this limitation of 10%, 10% of Microsoft's taxable income for a year, for example, is a huge amount of money. And so, again, that's a good thing, that corporations can give and get deductions for it, and it can be a fairly substantial deductions, even though it appears to be limited. Okay? Excess contributions over and above in a particular year, say you made more than 10% or you want to give more than 10%, you've got to carry forward of your excess for 5 years that, again, you can keep taking off your taxes.